Analysts noticed something unusual long before the restructurings began. A valuation gap was forming, quietly, consistently, between companies with tightly focused portfolios and those still carrying the weight of sprawling, unrelated categories. Quarter after quarter, the pattern held. Businesses concentrated in one or two high-growth lanes earned higher multiples, steadier expectations, and cleaner narratives. Diversified giants, meanwhile, were being priced not for their strengths, but for the slowest parts of their portfolio. That divergence revealed the first crack in a strategy that defined consumer goods for decades. The assumption that diversification made companies stronger was beginning to break down. Consider Kellogg's decision to separate into Kellanova and W.K. Kellogg Company. The logic wasn't emotional, it was financial. Snacks consistently delivered mid-single to high single-digit growth globally, while cereal followed the trajectory of a mature, slower category. Combined, they produced a narrative too complex for capital markets to value cleanly. Split apart, each business could finally be judged on its own fundamentals. A similar dynamic appeared inside Unilever, where ice cream, despite strong brands and global reach, operated with a completely different cost structure, supply chain, and seasonal rhythm than personal care and home care. By announcing plans to separate the division, Unilever effectively acknowledged a truth investors had been pricing in. Categories that grow at different speeds rarely belong under the same strategic umbrella. When categories require different capital intensity, innovation cycles, and retail strategies, the faster business doesn't lift the slower one. The slower one drags the faster. Average performance becomes the ceiling. You can see this tension inside General Mills, where pet food has become one of the company's strongest growth engines. Yet for years it sat beside divisions with lower momentum and lower pricing power. The contrast wasn't just operational, it was structural. One category needed rapid innovation and brand storytelling. Another relied on stability and incremental updates. Those mismatches compound over time. Kraft Heinz faced a similar reality. By divesting cheese, nuts, and certain international assets, it began concentrating capital on categories with consistent repeat rates and strong brand equity. Focus, not scale, became the center of gravity. Pressure from the outside accelerated everything. Private label growth reshaped center store dynamics. Consumers became more selective, consolidating their choices around fewer preferred brands. Retailers hardened promotional structures as supply chains grew more volatile. The companies getting rewarded weren't the ones with the most categories. They were the ones with the clearest purpose. Mondelez International, which leaned fully into snacks years earlier, proved the advantage of clarity. With a portfolio centered on biscuits, chocolate, and gum, it allocated resources without internal competition from slower growth or capital-heavy units. Simplicity became a multiplier. Meanwhile, Nestlé sharpened its focus on coffee, pet care, and specialized nutrition, segments with strong pricing power and long-term demand. Simultaneously, it exited slower growth confectionery in the US, trading breadth for strategic depth. Other companies took parallel paths. Campbell's Soup concentrated around snacks after the Snyder's-Lance acquisition, recognizing that crackers and chips delivered more headroom than many shelf-stable meal categories. The J.M. Smucker Company divested baking brands to double down on coffee, spreads, and pet food, areas with stronger brand loyalty and better shelf economics. Danone reorganized its structure to support health-driven categories that align with long-term consumer trends. Across the industry, the same forces were at work. Different supply chains, different gross margins, different advertising requirements, different category CAGRs. The more mismatched the categories, the harder it became to create a unified strategy that lifted all of them equally. The flaw in diversification wasn't diversification itself. It was diversification without synergy. Categories expanding at different speeds can coexist, but only if they share manufacturing logic, consumer behavior, or long-term strategic purpose. When they don't, complexity turns into a hidden tax. For decades, scale offset that tax. More brands meant more leverage, more negotiating power, and smoother earnings. But as consumer preferences fragmented and digital commerce weakened some of scale's traditional advantages, the calculus shifted. Scale still matters, but only when it compounds, not cancels itself out. Then came the forward-looking signal. Investors began assigning higher valuations to companies with clearly defined category identities and lower valuations to those blending unrelated businesses under one corporate banner. In other words, capital markets started rewarding strategic purity. When companies separate, they aren't shrinking. They're choosing which future they want to scale, freed from the gravity of mismatched divisions. Each new entity gains sharper incentives, cleaner investment priorities, and a narrative that aligns with what the market actually sees. This raises a question that quietly reshapes boardroom agendas everywhere. If focus consistently earns better multiples and clearer performance, how many conglomerates will still operate as conglomerates a decade from today? In the end, the breakup of big brands isn't a retreat. It's a recalibration toward portfolios where every category grows in the same direction, at the same speed, under the same strategic intent. A quieter, more deliberate kind of scale.